As the UK economy emerges from a shallow recession, we are seeing mortgage rate reductions, hopes of interest rate cuts, and a more stable market with new opportunities. In this update, I'll explore the macro overview of market conditions. Katie will cover construction output, materials and commodities, while Mike will run through pressures on labour and MEP, mechanical, electrical and plumbing. In the UK, inflation fell to 3.2% in March, the lowest since 2021, primarily due to lower energy costs. Although the central bank held interest rates at 5.25% in May, it signalled it is getting closer to reducing. This reduction in financing costs could be crucial to reviving demand and moving projects out of their current holding pattern. The UK construction PMI, a broad measure of overall activity in industry, has improved for the second consecutive month, reaching a 14-month high. Meanwhile, the job market is showing signs of cooling, with unemployment rising slightly in the last quarter, from 3.8% to 4.3%. One thing to keep an eye on is the general election, as it will play a pivotal role in market conditions.
In Q1 of this year, UK construction output is estimated to have decreased by 0.9%. The ongoing impacts of high interest rates, elevated construction costs and election-related uncertainty all weighed on output growth. However, output is forecast to grow by 2.1% in 2025 and 3.6% in 2026, driven by falling interest rates, which creates an attractive market for investors. New orders experienced a partial bounce back in Q1, rising 16% to 10.4 billion, driven by both private and public sectors. Material prices have fallen by 2.2% over the past year, primarily due to decreased global demand, lower energy costs and improved product availability. However, the decline is slowing, indicating prices may be stabilising. Looking ahead to the remainder of 2024 and into 2025, commodity prices are forecast to slightly decrease, according to the World Bank, but will remain 38% higher than before the pandemic. Strong demand and ongoing concerns of supply disruption are expected to keep commodity prices high.
Skilled labour shortages continue to put pressure on wage growth. However, with growing spare capacity in the market, demand for labour has softened. Construction vacancies are down from the 2022 peak, primarily due to weaker new order growth and softer demand. This has helped ease pressure on construction wages, which rose by just 2.1% in the year to March, the smallest increase in 3 years. Another important trend is rising prices in the MEP market. Capacity constraints in the Tier 1 supply chain and high demand from sectors like data centres and life sciences are driving prices up. Specialist MEP items are seeing high levels of inflation, which will likely result in above-average package inflation over the next year. To help projects succeed, it's important to take mitigating steps, like involving MEP contractors early in the design stage.
To summarise this quarter's 4 key takeaways. 1. The market remains stable, creating opportunities for contractors to secure future work. 2. Material prices are steady, but the occasional spikes in cost may still occur. 3. Reduced interest rates could unlock funding, allowing new projects to start. And 4. Although the labour market is still competitive, it's beginning to show signs of balance. So overall, challenges remain, but we see a window of opportunity before the construction market picks up next year, making now the ideal time to advance your projects.